Hello and welcome everyone. This is John Person reporting for the Bottom Line Commodity Report. It is October 1st on Monday morning. That means it is Sunday, and I am doing a video as we've concluded the newsletter in front of an incredibly exciting Writers' Cup. But in any event, I wanted to get through as we have a lot to discuss today because it's the end of the quarter, it's the beginning of a new month, it's the beginning of a new quarter, and let's take a look in, and we're in a presidential election year cycle, so a lot to talk about. Let's get the little stuff out of the way first. In the week ahead, as far as earnings, I don't think it's really going to be a big deal, but Mosaic's coming out on Tuesday. Wednesday, we have Marriott, Family Dollar Store, and Monsanto. Then on Thursday, not much in the realm of earnings reports, because in the next couple weeks we are beginning the end of third quarter earnings season. But nonetheless, on Friday we have Constellation Brands, and that's about it for any of the big earnings reports. As far as the economic numbers, though, this week we have, of course, Friday will be the monthly unemployment jobs number. We have the ISM coming out on Monday. So, again, I think a lot will be focused on what's going on in Europe. Spanish banks. Don't think that the big number of is construction spending. I think the big number, of course, is the unemployment number, and people are already pricing in 100,000 or less. So might be if it comes in weaker than say 88, 87,000, and with weakening revisions, I think then it'll be a good explanation as to why Ben Bernanke was so boisterous as to being adamant about adding liquidity and having QE3 infinity. We call it QE3 infinity because he said it would end when the Fed sees necessary, and it would see to continue easing going beyond 2014. So again, long time of easing. Plus, don't forget we've got central banks abroad, the ECB as well, pumping money into the banking system. So with that said, let's take a look at the stock markets here, because to be truthful, on a daily basis, all the charts have the same kind of little pattern here. It looks like flagpole and minus this counter trend rally could be a little bear flag. So I've got the numbers here. A daily close over 14, let's call it 1445, negates that bearish pattern. So a daily close over that pattern negates that bear flag. And of course, closes, if you get a close underneath this little minor trend right here, and underneath 14 and a quarter, I think you're going to see a pullback, because this flag would measure down to around 1395 or so. Monthly support is 96, and we have this moving average crossover around 1406. So the intermediate support is going to be, let's call it, right in that zone. From a seasonal perspective, we do see the markets generally tend to weaken going into the middle of October, but this is an election year, so things are quite a bit different. As far as this decline in the stock market, we did see a reversal or a decline with associated with an increase in downside volume. So there was a little trend line break. On balance volume is below my little moving averages in here. Stochastics shows that the market is still in an oversold condition, but it's coming close to oversold, but it's not. It's still in that gray area that we could see continuation low. In this month's newsletter, I talked about the no new trade wrecks in the S&Ps, because quite frankly there is no weekly sell signal, and I think it just to put out a monthly trade right now in this environment, there's a lot going on. I'd rather just do a maybe an announcement in the trading room and send out a tweet or an email alert as well. But as we can see with the commitment to traded data showing hedge funds went long 3 weeks ago, they're still long, so are small speculators. The S&Ps didn't form any type of discernible chart pattern, only than the daily potential bear flag. On the NASDAQ, though, we have a bona fide weekly low close doji, and we have this little bearish divergence with the AD line on the NASDAQ. That same type of pattern does exist, by the way, with the Dow. So let me show you the Dow real quick. All right, so here's the Dow. There's our little low close doji, but we still hovered above the monthly predicted pivot as well as both moving averages. So really, you can't get the party favorites out right now. The advanced decline is not as weak in the Dow as it is in the Nasdaq, and again with the S&P. So I just wanted to share that information with you as we take a look on a weekly basis here. Now let's take a look at a daily chart. You do see prices tried to make a higher high. And we did not make a higher high. In fact, as you go along and we take a look at this together, you'll see this is the line in the sand of the highs earlier back in May in the Dow, and we barely scratched the surface of that AD line when prices made a substantially higher high. But notice that these old highs in here around this 13.2 and change, or let's call it 13.3, that has been acting as an old resistance. It's also acting as a new support because that was, if you think about it, we were 13,293. That was, 13,294. This is the old resistance. It's turning into new support. So we're going to have to see some amazing follow through early in the week to get this trend reversed to the downside. How far will it go? We'll take that one day at a time. I think that at the very least, the first support, if we break this 13.3, I'm only looking for perhaps maybe coming in and testing a low here at around 12.9, maybe come right in to the monthly support around 13,000 even, or 12.9, 90, just right around the lows that we saw in September. So if you look at that, it was around 12.966 area, okay, or 12.965. Let's be exact. All right, so we have several mixed messages in the S&P, in the stock sectors, all right? And when we take a look at the bonds, one of the things at the end of the chart in the newsletter, I supplied first off, a chart on the actual 30-year bonds, which shows them in a range. And at the last page, I showed, of course, the knob spread. And on that chart in the knob spread, it had the 10 years, it had the 30-year, and it had the Dow Jones Industrial Average as represented by the diamonds at the very bottom. And it shows that as the trend. Here, let me get that into play for us. All right, so as you can see, this is on the newsletter. Here is the actual spread chart. It shows that the spread is widening. When that happens, it shows that bonds are outperforming notes. And as you can see, it's been kind of choppy in this little range right here. So in that range, what that shows us is that as the bond prices or the spread weakens, it shows that the stock markets have strengthened. As we see the right down here below, as the spread widens from this point going up, all right, so say like from April low in the spread right here, the spread widened or went more positive. In that case, you'll see that the notes rallied, you'll see that the 30-year bonds rallied, and you'll see that the stock market declined. Then as the spread kind of weakens or moves sideways, we see the notes come down, the bonds come down, but the stock market rallies. So we're at that point right now. If the bonds do or this spread widens, it's probably because we're seeing buyers come in to the interest rate markets for a flight to safety, and they're coming out of riskier investments such as the stocks, and we might see that trend down. But so far, overhead resistance in the individual bonds is holding, underneath support trend lines in the Dow is holding. So that's what makes this a little bit tricky. So that's why we don't really have a recommendation both in stocks and bonds right now, but we do have recommendations in the Japanese yen. We do have recommendations in the euro currency. We have one in the crude oil. Gold and silver can wreak havoc in the month of October, but right now with the fear and the printing that's going on, I do not have definitive signals. If anything, we take a look at the gold right here. We have a double doji star. So this is an ominous formation, and if we get a close on a weekly basis below that, we could see a move, and I'm not saying it's going to happen, but we could see a move back to about or test this point of breakout, which would still be an overall trading range type of environment. I'm not saying that it will get there, but first thing we would have to do, if we get a low close doji on a weekly basis in gold, from a seasonal perspective, typically we see gold kind of, move to the downside going into November. So after the elections, we could certainly see a move come back down in gold. It's a pretty ominous, scary type of pattern. I wouldn't want to be long. It shows that after this long little uptrend, there's a lot of indecision. And for the last 1, 2, 3 weeks, indecision on this rally, we've been just bombarded with bullish news, bullish news, bullish news. Everyone wants to buy gold, everyone wants to buy gold, and yet we have 2 weeks back to back with doji formations. That shows indecision. So it's tough to get short based on the fundamentals with the banks printing money like mad, and it's really hard to go long with these dojis facing us in a seasonally weak period of time. So that's why we're holding tough with the gold. I found some other trades that I thought were kind of intriguing that aren't really going to be maybe as dictated with the or interconnected with the politics and the political outcome. But in sugar, we look for a seasonal buy, and the market's been consolidating. And I think that because of the drought conditions and because of the increase in demand, and the substitute for ethanol, we could be seeing an increase in demand for sugar. This could be a nice little trade. So we do have a nice long trade set up for sugar, and it breaks my heart to sell cocoa, but seasonally speaking, we do have a sell in sugar. It's in a weekly sell mode, as I've written about in the newsletter, and so there we have several of the top markets that we're looking at this month. And also I just wanted to explain what the heck those spread charts were doing in the newsletter this time around. As far as any newer trades coming, we're going to do planning and scanning on Monday in the trading room, so please join us. Live cattle prices. I wanted to talk about live cattle prices, but we have this weekly sell mode right here in live cattle prices. And from a seasonal trend, we see the market kind of go down. It's not the same back in here. Now, back in earlier this year, we were doing all kinds of spread activities, and we continue to do spreads pretty much this year in the cattle market successfully. We didn't get rich quick off of them, but we did have some nice profitable trades. I think that in this environment, we could continue to see weakening prices into November in the cattle market. This is a bearish engulfing pattern. I just wanted to share it with you because maybe if we get a rally and it fails in the midpoint around 126, 127 in the December live cattle futures, we'll be looking for a setup to sell short there. So I just thought I'd bring that to your attention as well. I hope you found this information helpful. We have certainly a lot to look forward to this month in October, and especially this first week. Boy, do we have a lot going on. We also have the Chicago Money Show, which I'll be at and speaking on Thursday. So if you are coming to Chicago, or if you are here for the Ryder Cup and you're sticking around at the Money Show, God bless you, and we'll look forward to seeing you. Thank you all very much. If not, just remember, in 2 weeks, I'll be in Toronto at the Toronto Money Show. So I look forward to seeing our friends up north of the border. Everyone, hope you enjoyed the Ryder Cup. Hope you had a great weekend. Thank you all.